Hey guys, Tony Denaro here. Welcome back to the channel. Thanks for joining me. If you are new to the world of crypto, today we're going to be talking about stablecoins. What are they? How long have they been around? What are the risks? What are the benefits? And what are the different types of stablecoins? So spend a couple minutes with me and let's talk stablecoins. Stablecoins have been part of the crypto world since 2014 with the introduction of one called Tether, which, not surprisingly, is still the #1 stablecoin. If you want to see all the stablecoins that are out there, you can use a website like CoinGecko and go to categories and select stablecoins, and it will show you a bunch. There's almost 100 here on CoinGecko, with Tether having a market capitalization of $82 billion, USD Coin, which originated in 2018, coming in at #2 with a market capitalization of over $50 billion, followed by Binance, TerraUSD, Magic Internet Money, and a host of others all the way down the chain. We're not going to spend a lot of time today talking about specific ones in this video. I'll go into some of them in some subsequent videos for you. Today, we're going to get right into what are stablecoins. So what is a stablecoin and why do we have it? Well, there is a problem with cryptocurrency, and it is that cryptocurrencies tend to be volatile. And if you need a place to park your money and you don't want to take it out of your crypto wallet, well, there needed to be a solution. And that is where stablecoins came from. Stablecoins are a class of cryptocurrency that attempt to offer price stability, and they're often backed by a reserve asset or a basket of assets. So what are the benefits of stablecoins? Why would you want to own one of those in your crypto wallet? Well, for one thing, they more or less have no volatility. They have mobility and accessibility for your crypto. They offer lower fees than fiat or cash currency. And they offer efficient moving of capital, whether that's from wallet to wallet, exchange to exchange, or even from person to person or business to business around the globe. Stablecoin users don't need multiple international bank accounts to send cash or crypto to friends or businesses around the globe. You just each need a crypto wallet. It's really that simple. No more wire transfers or bank transfers and all of the fees, time, and hassle that go into that. In other words, stablecoins make true peer-to-peer digital transfers possible without the need for third-party intermediaries to facilitate these transactions. Now let's talk about the different types of stablecoins, and I've put them in 5 different buckets for you. The first is fiat-backed stablecoins, those that are backed by an actual currency. The second would be a commodity-backed stablecoin. Number 3, a crypto-backed stablecoin. Number 4, algorithmic stablecoins. And the final one is still relatively new, a CBDC, central bank digital currency. Now let's get into a brief explanation of what each one of these is. And I'm going to start with the fiat-backed stablecoins. A fiat-backed stablecoin is most typically pegged to the US dollar. Fiat collateralized stablecoins maintain their 1-to-1 ratio with the dollar by utilizing trusted third parties to hold an equivalent amount of legal tender in reserves. New stablecoins are minted when a party, such as yourself, deposits US dollars in the issuer's reserves. And similarly, when you take that money out, when a redemption request is made, the issuer will send you US dollars and they will burn the redeemed stablecoin. Next up is commodity-backed stablecoins. Now, these are most typically backed by something like gold. Commodity-backed stablecoins have the backing of different types of interchangeable assets, such as precious metals. The most common commodity used as collateral for commodity-backed stablecoins is gold. However, other stablecoins have the backing of assets such as real estate, oil, and precious metals other than gold. Next up, we're going to talk about crypto-backed stablecoins. Yes, backed by something like Ethereum. Crypto-backed stablecoins hold cryptocurrencies such as Ethereum in escrow for the issuance of their new tokens, their new stablecoins. Now, we all know crypto is volatile, so the collateralization requirement for this type of stablecoin is usually 150%. to allow for volatility. In other words, if you were going to buy a crypto-backed stablecoin like DAI, ticker DAI, and you wanted to mint $100 worth of it, you would need to deposit $150 worth of Ethereum to make that happen. We are almost done with the list. Number 4 on the list is algorithm-backed stablecoins. Now, an algorithm-backed stablecoin is not backed by any sort of reserve. Non-collateralized or algorithmic stablecoins do not have any assets or collateral backing them. Now, this basically works off of supply and demand, and the algorithm stablecoins follow the algo for controlling the stablecoin supply. If demand rises, new coins are created by the algorithm to return the price back down to the pegged point. And if demand is falling, the algo will remove stablecoins from circulation to maintain the pegged price. To close out our list, we're going to be talking about central bank digital currency, CBDC. They are relatively new. In fact, we don't have one yet in the United States, but I'm going to be covering this more in depth in an upcoming video because it is now being looked at by the United States. A CBDC is virtual money backed and issued by a central bank, like the Federal Reserve. 87 countries are now exploring central bank digital currencies, and this represents over 90% of global GDP. 9 countries have now fully launched a digital currency, and of the countries with the 4 largest central banks, including US, European area, Japan, and the UK, the United States is the furthest behind in exploring central bank digital currencies. Before I do my final slide with you covering the risks of stablecoins, I want to talk with you very briefly about what might be a use case of why you would use a stablecoin just for yourself. Let's say you have $1,000 or $10,000 or $100,000 in your crypto wallet, and let's say it's invested in Bitcoin and Ethereum, and you're worried that crypto is going to see a decline in the upcoming days, weeks, or month. You don't want to remove all that money out of your crypto wallet because that's just a hassle, and you got to pay fees, and it takes time. You can trade your Bitcoin and your Ethereum and your other cryptos very easily for a stable coin. Keep it there in your crypto wallet, and it won't lose value because you've moved it into a stable coin. So while Bitcoin and Ethereum or whatever else is falling in the crypto markets, you've been able to keep your money in your crypto wallet and not lose value. And when things have fallen enough, it's very easy to go back in and buy the dips. Your money is right there in your crypto wallet, and you can do it instantaneously, going back from your stable coin back into the cryptos of your choice. Now let's talk about the risks of stable coins. What are the risks? Well, there are a few that you should be aware of, like with all cryptocurrencies, but one in particular to stable coins is the counterparty risk. You're trusting a third party to essentially print money and give it to you and keep their cryptocurrency, their stable coin, stable. The dollars could be only fractionally reserved instead of fully backed. Now, what does that mean? That means that some of these stable coins are not fully audited to ensure that they have assets on hand to back the stable coin. Tether is a good case in point of this. There's a lot of debate right now whether Tether, the #1 stablecoin, fully has the amount of assets needed to back the stability of that stablecoin. It is for this reason that myself and friends that I know that are in the crypto world most often use the #2 stablecoin, USDC, as the stablecoin of choice. The second risk is centralization risk. Accounts can be embezzled, blocked, hacked, or accessed by unauthorized third parties. Now, this is not unique to stablecoins. This is a risk with all cryptocurrencies. And if you're dealing with an algorithm-backed stablecoin, there is always a risk that the algorithm could fail or that the algorithm could be manipulated by a third party. This is not common, but this is a risk that at least you should be aware of. And that's why I use something like USDC, the #2 stablecoin, which is backed by verifiable assets, as my stablecoin of choice I don't use any algorithm-backed stablecoins. That is going to wrap it up. The high-level overview of what are stablecoins. I do have some other videos coming out for you guys talking about Tether, talking about USDC. If you have any others that you'd like to have me look at for you, drop me a comment down below and I'd be happy to do that for you. Don't forget to buy and hold that subscribe button, and I will see you on the next video.
So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid?